Hey guys, welcome back to the channel. We're getting to that time of the year where people are looking to purchase homes because the kiddos are going to be out of school here in about 2 months. And so today I'm going to go over what my version of a strategic home buying blueprint to help those of you understand the process regardless of where you are. Maybe you're not buying this year. That's fine. We want to continue to educate you to give you the information that you need to prepare yourself so that when your time comes, it's not anxious and like you're sitting on pins, because it can be if you don't know. So for those of you that don't know me, my name is Robert, and on this channel, we simplify the home loan process. Also, I'm a lender. My NMLS license number is 180100, and my contact information is pinned in the top comment and the description of this video. Let's get into it. We want to help you understand this process because it could be somewhat intimidating for you if you've never done it. Heck, even if you have done it, if it's been a while, it could be something that can be a doozy. So here are the things that you need to know to help smooth out that process. First thing that we want to go over is your non-negotiable or negotiables. This is your financial baseline. Ultimately, the best case scenario is for you to be debt-free. Now, I know some of you might be saying, well, Robert, that's impossible in the times that we're in, but you'd be surprised. There's some of you out there that will hold off on buying until you're debt free. Let me identify debt free. I'm speaking of car loans and student loans. If you can get rid of those types of things before you purchase a house, it's just going to make your experience that much better. But we're living in the real world, and if you have those things, it's not a deal killer, but it's good to have a baseline for you to understand what you're getting into, because this is a payment that's going to be around for a while. And so you want to make sure that once you get into a home, it does not cause you to have buyer's remorse and you regret it. Regardless of your debt situation, when you're buying, you must have some reserves. How much? 3 to 6 months. How should you calculate that? Well, you should know what your current expenses are. And once you go through this process, you'll have a very good idea as to what a potential mortgage payment is. And you need to have minimum 3 months of that after you close, and in something called an emergency fund, meaning that it's not in the daily driver. It's something that's to the side. It's not an investment account. It's something for emergencies, because life happens. Once you've defined your non-negotiables, then it's time to get into some number crunching. The golden rule that has been that for a while is that you never take out more than a 15-year fixed interest rate mortgage, because if you double the time, the 30-year fixed mortgage, just naturally you're going to pay that much more in interest. But if you can't do a 15-year mortgage, you want to try to stick to this next one where your payment, principal, interest, tax, and insurance payment does not exceed more than 25% of your take-home pay. If you're going through these steps and you're planning, I'm going to give you the best case scenario, but that is not hard and etched in stone. There's different scenarios on that continuum, and people have been able to be successful owning homes, not with these rules, but these are the benchmarks to help you not be one that is remorseful after getting in your home. You still can qualify for almost twice that amount, but does that mean you should do so? You want to be conservative when you're buying a house, because you got to have some room for growth, and you just don't want to be pinned down. But your lender will help you determine what is your optimal situation once you get to that point. If you can save and put 20% down, then you won't be beholden to private mortgage insurance, nor mortgage insurance premiums on an FHA loan, because if you're putting 20% down and you have everything else in line, probably would be better suited doing a conventional loan, unless you're going USDA or VA. But that private mortgage insurance is something that is mandatory to protect the lender, really to protect the end investor, the folks that are buying these loans and getting the interest off of that, they're made whole in the event that there's a problem. But it doesn't protect you. It's an extra cost. Depending on your viewpoint, I'm an optimistic type person. It allows people to get onto the property ladder when they might not otherwise be able to do so because they don't have the 20%. As a first-time home buyer, there's conventional loans with as little as 3% down, FHA 3.5%. If you are an active duty or retired military service person or spouse, qualified spouse, and you have earned that right to use a VA loan via the certificate of eligibility, you don't have these types of things. That's why I say VA loans are the best loans out. But it's about mitigating cost or limiting costs if you can. And if you're planning this out, these are the benchmarks that you want to look for. Just keep that in mind. And check out my jargon buster there. Private mortgage insurance. Foreclosed insurance you are forced to buy to protect the mortgage company. It does absolutely nothing for you. I won't say that it allows you to get into a home sooner rather than later, but you want to get rid of that private mortgage insurance as soon as possible. And there's ways to do that. So most realtors that are real tours won't show you a property without being properly pre-approved. We pre-qualify, folks. The difference is I'm actually going to get all of your documentation. I'm going to vet your income, taxes, identification, asset statements to make sure that, hey, when this realtor goes out, you actually can afford said home. More importantly, would you want someone just walking through your home if they've not been vetted if you are a seller? Pre-approvals, pre-qualifications play very important roles on both sides. There's a lot of shenanigans that go on and you want to protect yourself because you cannot be pre-approved just by someone pulling your credit and saying, hey, you're good to go. That is not worth the paper that it's written on. So be leery of those types of things. As it says here on the slide, pre-approvals expire anywhere between 30 and 90 days. It could be sooner. I had to expire one here recently because I didn't get all the documentation that I was told I was going to get. That's very important because my name is out here. I'm saying, hey, I've validated this information. For the most part, when you do what you're supposed to, they're good for 30 to 90 days, and that's pegged to your credit report. Moving forward, you want to navigate the market with strategy, not panic. There's a lot of panic going on today, and that's not what you want to do. You want to have a strategy. As inventory is rising, and it's been rising in a lot of markets, you always have to check what your local market is, but it's one in which you don't have to rush as much, but you do want to be proactive if you're looking to buy a home. Why go through all of the preparation if you just want to kick tires? But we're getting to a lot of inventory in some markets, which makes it a buyer's market. You have a little more time, but if you remember a couple of years back when inventory was very low, you didn't have the luxury and there was a lot of panic buying going on and folks skipped a lot of the things that we're going through. So we don't want that to happen to you. You always want to focus on your personal financial readiness and your local market trends, not the national gossip lines. Headlines. They always sell drama. Remember this, if it bleeds, it leads. Where the attention goes, the money flows. Stick to your guns, know your number, know your local market where you're looking to buy, and make your decisions based upon that. Here's the roadmap. This is what you've been waiting for, 10,000 foot view, because really I was just going through my processor's checklist and trying to get a good heads or tails, and there's 1,500 to 1,800 steps that are taken from the time that you say, hello, I think I want to buy a house, and you reach out to a lender. So there's a lot of things going on the back end, but these are the things that I think that you need to know. We already talked about it initially, your financial preparation. Once that's done and you've been properly pre-approved or pre-qualified and you get out with that realtor, the home search actually begins. And however many homes you look at and you finally make the decision to make an offer on a home, this is a very important point and why you need to be financially prepared, because to make an offer on a home is going to take anywhere between 1% to 3% of the asking price of the home, aka earnest money, and $100 or more for option money so that you can do your due diligence. So this is why you have to be financially prepared. And if you're not, you don't have to worry or beat yourself up. You just got to get prepared. Once that offer is made, earnest money goes to the title company that lets the sellers know, hey, this person is serious. And those monies that go to the title company, if you decide to consummate this contract and close on it, those monies will be credited towards the total amount of money that you have to come out of pocket with. Now that option fee, depending on how much it is, that's your insurance to do your due diligence and have an inspection on a home. Another cost. The inspection cost varies. I won't try to pin it down, but it's going to be minimum $300 or more. And that's where you're having someone come out on your behalf and looking at the major systems or any got yous. This is also a potential renegotiating point, depending on how it goes, or a walk away position. You have to be financially prepared, because if you're not willing and able to walk away from $300, then you could get yourself in a bad way as far as buying a home. Let's assume that everything went good on the inspection and you said, you know what, we're ready to move forward. Now you have an executed contract and the clock is ticking, meaning your lender, everybody has to work together to make sure that you're able to close within a contract time, or you would have to get something called an extension, or it could cause problems. For us, I'm a stickler. Barring an appraisal situation that is out of my control or a title situation, which at the time of this video, I'm dealing with a couple of them. It's frustrating to me, but it happens. But because we did everything correct in the first 3 steps, you should be able to close on your home loan within 30 days because we've done the heavy lifting. Once it's under contract, that's when the processing begins. We collect everything. Most importantly, order the appraisal, survey if it's applicable in your transaction. You might have some different inspections that have to be done depending on the type of home you're buying. You might have a septic inspection, well water inspection, so on and so forth, case by case. But now we're off and running so that when the appraisal comes back, my goal is to have everything ready so that all we have to do is clear up the title issues and the last things that you need to do or have to get to what's called a clear to close. That's the processing. And then ultimately, you're going to go to the closing day. You'll do your final walkthrough the day of closing, make sure everything is good with the property. You go sign all your documents. And depending on when you close and what type of loan you have, your loan payment could be as early as the next day if it's at the end of the month, depending on what type of loan you've done, or 45 days away. That's something that your lender will explain to you. That's the 10,000 foot view of the home buying process or the roadmap. After you understand that, just to go a little more granular, when you secure the contract, those 2 upfront fees that we talked about, just to reiterate, earnest money, option fee. Earnest money could cost 1% to 3% of the purchase price. On a $400,000 home, 1%, that's $4,000. And it has to be submitted to that title company in a certain time frame to let the sellers know, hey, I'm going to take my house off this market and potentially lose another buyer so that you can do your due diligence, which goes over to the option fee. I put a $150 to $350, but I've seen them as high as $1,500. It just depends on the property that you're buying and what the inspector has to inspect. Home inspection, you can always get one, even on a new build. Don't think you can't. And be honest with you, nowadays, I would get one on a new build, probably more so than on some existing homes for various reasons. But anytime you got major structural issues, foundation, mold, failing roofs, dying AC, HVAC systems, those are deal breakers or renegotiating points. And then distractions, flickering front porch lights, scuffed paint, minor drywall cracks where the joints are. You don't need to walk away for aesthetic type things. There's no perfect house. When you look at the danger zone, after all those things are done and you've gotten into underwriting and everything is good to go, when the appraisal comes in, this is where we, the lender, verify the value that it matches what the contract sales price and offer is. And this is a place that I want to explain as well, but you as the buyer or buyers pay for the appraisal. I had someone ask me, well, why am I doing that? You're the lender because it's your home. We're lending you guys the money. That appraisal fee will be credited towards the total amount of money that you might have to come to closing with, but it is your responsibility. Here's the red flags. Once you get to this point, do not go out and buy a car. It's happened to me several times. And folks, in 2 of those situations, were not able to purchase their home. Don't jump the gun and go finance any furniture. Those same as cash, 12 months, 24 months. Don't do nothing, in the voice of Dollar Bill, Players Club. Don't do anything until you get the keys. Why? Because as lenders, we are monitoring your credit throughout, not because we're the police, but when your loan is packaged up and sold to the end investor, they do audits. And I'll give you an example. I had a situation where it was a pilot and a nurse, and they purchased a home. And prior to us closing on that home, we do a third-party verification of employment to make sure everybody's working. Well, the wife's employer said that she was working. 4 years later, somebody say 4 years later. 4 years later, this loan was sold to a different investor. The servicing changes, that's a part of the business. But they went back and did a audit because you'll sign something called a 4506T. And anyway, in the audit, they found out that when we closed and did the verbal verification of employment, the wife actually wasn't employed anymore. That's mortgage fraud. And so it worked out. But my point is, don't shoot yourself in the foot. Don't do anything without talking with your lender, and just wait, man. Just wait till you get your keys. You're almost there. Closing costs. Let's decode them. Prepaids and escrows. The reality at closing, lenders will collect a hefty out-of-pocket expense, 3 to 6 months of property taxes and insurance to initially fund the account. So your escrow account, there's been a lot of hubbub about escrow accounts. You might hear people say, my mortgage went up again. Your mortgage payment did not go up again. Your taxes and insurance went up, or either or. That's where you need to understand those things can change. And if you put less than 20% down, you mandatorily have to have an escrow account. So that's what people are talking about. Those prorations happen like this. Say you close in March of a year. Say your taxes in that county that you're in are due in December. Well, if you close in March and your first payment is 45 days away or so, depending on when you close in March. So March, April, May. Your first payment is May. So we have June, July, August, September, October, November, December. We only have 7 months of you making a payment to make sure that all of your taxes for that year are there for the servicer to send to the taxing authority. This is why there's a certain amount of money that could be collected in escrow, but not too much. And sometimes based upon the analysis of the escrow account and the way taxes go up or down, this is where you might have an escrow shortage or too much. I just got a check back on one of our properties because there was too much collected in the escrow. It's not always the increase. Sometimes they collect too much, but escrow analysis are very important. And these are things that you need to do a couple of times a year to make sure you know what's going on. Got some videos on the channel to handle that. I don't want to go off too much, but prorations depend on the closing month. You will either receive a credit or a charge from the seller to balance the tax bill. We're talking about at the time of closing. In my example, let's say the seller owned the house from January 1st to March 15th when I took over the home. Well, I'm going to give a paper credit to the seller for the time that they own the house. If that example happens where the seller paid for the taxes in that year, well, from the time the taxes are paid, say from October, if taxes are due in that year, and I close in November, I will give a credit to the seller for the time in November that I close to the end of the year because the taxes have been paid for that year. Don't want to turn you into a loan officer or anything. My point is you want to understand these things. And I think the takeaway with the escrow account is that taxes and insurance fluctuate. If you have private mortgage insurance, it's always going to be the same. And the principal and interest on a fixed interest rate loan will always be the same unless you refinance. If you have an adjustable rate mortgage, it can fluctuate. Let's move forward. The trap of buying down the rate. This is something that a lot of you guys, this happens to you and you don't know it happens to you. This is way back in the front when you're getting pre-qualifications and your lender might say, okay, I could get you a rate of 5.5%. And then you shop with me and I say, okay, the rate's today at par is 6%. You're like, well, I'm going over with Johnny because I'm getting 5.5. Whole time you don't know you're paying 2%. 2 points to get that rate up front. And as it's saying here, origination fees and points are pure profit for the broker or the lender. Prepaying all the interest takes roughly 8 years to recoup. I'm not going to demonize points or discount points, but what I will say is you have to know, based upon what you and your family are doing, how long you're going to live in that house. Because you might leave before you can realize the benefit of all that money that you paid for up front to recoup it. Simple calculation can figure that out. So you got to compare apples to apples if you're going to shop and not just look at the interest rate. You have to understand what the costs are on a deal. Here's a strategy. Ask your lender for a par quote. What does par mean? You ever heard par for the course? Par is 100, okay? Anything over 100 should be a credit back to you as a buyer. Anything less than 100, you have to make up the difference to get to 100. So say that interest rate that I just mentioned was, like I said, it was 5.5%. Well, the rate at the day that you were given that, it was only paying 98%, where you, the buyer, had to bring the 2 percentage points difference to get to par. Well, $400,000 loan, as an example, 2 points, 2 times 4, that's another $8,000. This happens a lot in big marketplaces where people are accustomed to paying points. It's not always about the interest rate. You got to look at the whole picture and understand what's going on. And that's how you can tell if you're dealing with a good lender. So here's the deal. You want to protect your ownership at all costs. And you want to do that with an owner's title policy. That's what I know it as, right? At the bottom, the pro tip there. Always ask the title company for a simultaneous issue, and it's a marginal fee. It's typically $100, right? But that's an owner's title policy. Story time. I just had a young lady this past year reach back out to me, bought a house in 2022. And anywho, the title company did not do its due diligence, and there were some owners, some other heirs to this property. So she calls me one day and said, hey, I got this letter in the mail, and these folks said I need to pay off the house because it's their house. And I'm like, what are you talking about? Well, thank you, Jesus. All of my clients get an owner title policy. That's a good $100 spent. And long story short, the title company ended up having to pay the owners of that property because they messed up the title work, couple of $300,000, but my client still owns the house. That's the title insurance. So you always want to understand and protect yourself. And again, when you don't plan properly and trying to get into these homes for whatever reason, or you feel rushed or FOMO, these are the things that you take shortcuts on that could come back to bite you, and it could be catastrophic. Here's the reality of closing day. In the morning, you wake up, man, I'm finally closed. I don't have to talk to Robert anymore. I'm ready to go. You get with your realtor. You do your final walkthrough. Verify that everything is repaired. If there was any repairs in the agreement, make sure the house is where it's supposed to be, and you're ready to go. The day before, if you're dealing with us, probably 2 days before, we've already wired the monies, the loan monies, less any monies that you have to bring to closing, to the title company. And it's there for them on their bank line. You go in and you meet with a closer, and he or she is going to get your signatures and notarize things. Now, here's the deal. Whoever is executing the closing is not there to explain loan terms or anything of that nature. By law, they can't. All they can do is say, hey, call your lender. But if you're having to call your lender at this point, something's wrong. All your questions should have been answered. Anybody that's dealing with me, by the time we get to this, you're ready to go. And then you have the funding. So sometimes you must wait a couple of 2 to 3 hours. That's why I tell folks, hey, it's your closing day. It's a milestone in a lot of people's lives. Enjoy the day. Don't be in a rush, because this is a very large transaction, and it's like a big ship. It doesn't move quickly. And so you'll get your closing documents, your keys, and then you're good to go from that point. This is the 10,000 foot view of you going through a closing process. I know this video was a little longer. Hopefully it makes sense for you. And you may be saying, hey, you know what, Robert? I'm at that point where I'm ready to take the first step to get pre-qualified properly. What do I need to do? Well, I think you need to reach out to a lender that you know, like, and trust. And if that's me, as I stated earlier, my contact information is in the top pinned comment or in the description of this video. I would love to have a conversation with you to see if we're a fit and help you realize your goal of home ownership. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let us let grace abound. Check out these next 2 videos, and until the next time, indeed, y'all stay blessed.